Hello everyone, and I've just jumped on one of Elon Musk's super rockets. You know, they take off and then they land wherever you want them. I've just managed to land here in the beautiful Balmoral area and on a little barge just off the coast actually after my talk in Hong Kong. I hope you're able to zoom in for that panel discussion at the Wabi FX168 conference in Hong Kong on blockchain, metaverse, and of course a little bit on crypto. Coming back into the real world, we're seeing a lot of very interesting data, and it's not all positive. We saw non-farm payrolls in the US on Friday come in at a reasonable number, you know, well into the 500,000s, and that's good. It's a similar number to normal territory before COVID, so that's excellent. But still, the US needs to be creating a lot more jobs than that if it is to get back these somewhere over 3% of workers who've simply not bothered to come back into the workforce or can't get work back into the workforce. That is in addition to the unemployment levels. So in a way, if you assumed that the pre-COVID employed wanted jobs, unemployment in the USA is really closer to 8%. That isn't the case, of course. Some have gone, it's simply too hard, retired early. Unfortunately, a lot of women also have removed themselves from the workforce. Hopefully there'll be fresh opportunities opening up as the United States itself opens up its borders to full open travel, pretty much for the world actually. So we'll see what happens there. And in talking about people's movements, it's a rather quiet Sydney today, as many people have gone to regional New South Wales. It was only the previous Monday, so this was the first weekend people had a chance to leave for regional New South Wales out of the previously locked down Greater Sydney area. And so I think we're going to see a little bit of a sharp drop in retail and hospitality activity in the Greater Sydney area over the next 1 to 2 weeks, and a huge spurt in places like Byron Bay or Barrel and other parts of regional New South Wales. So again, even though you might want to say with vaccinations it's all over, these upheavals in economic activity, this sort of running from one side of the boat to the other en masse by large proportions of the population is going to continue to create distortions that are difficult to manage for small and medium-sized businesses and even large businesses. So a lot of upheaval ahead, and I had warned that the slowdown of the third quarter could well extend into the fourth quarter and even the first quarter in terms of economic growth in Australia. And Victoria will be going through a similar process. It's not, I really always said vaccinations do not equal economic growth. And I think that's going to be the painful lesson that we all have to learn moving forward. Australia is going to experience below trend growth, I think, for the next 1, 3, even 5 years. The RBA has to raise interest rates to avert asset bubble crises, which will only create a further roller coaster of economic boom and bust going forward. So it's not an easy place for the economy over the medium to long term, really, out to about 5 years. So most investment portfolios are pricing in a return to spectacular growth. It's just not going to happen. The RBA and the government have forecast a sharp economic recovery and rebound after the opening up. That's not going to be the case. There's going to be an economic rebound and a recovery. It's not going to be very big, and it's not going to be very spectacular at all. So just a little bit of caution there on the fundamental economic front within Australia going forward. And on the export front for Australia, the trade front for Australia, we saw terrible trade data for Australia last Friday. Imports, exports dropping, trade surpluses peaked. Very worrying across the board in what we were seeing in that trade data for Australia. And today or over the weekend, we've seen China's trade data come out. And at first look, it looks good because the trade surplus was a record high, not brilliantly higher than before, but certainly higher than before. That was largely driven, though, by a decline in exports, but an even steeper decline in imports. which really comes home and really rings true with the idea that China is indeed suffering a serious economic slowdown at the moment. And my suggestion is that this economic slowdown is a recalibration that will remain permanent. Everyone knows about Evergrande and a couple of the other property developers that have been at risk of late, but really they're kind of the canary in the coal mine. They're the weakest link in the chain. They're not the cause of the problem. They are victims of the problem, the first victims, if you like, and they're large enough to be noticed. They are warning signs that the overall China economy, particularly the construction sector and the housing sector, of course, given that they're property developers, but the overall economy is in fact slowing. And that was very much highlighted in the weekend's data on China's imports. So we are seeing a US economy that's trying to have a little bit of stabilization just now. I did forecast the severe economic slowdown that the United States has already experienced over the last 3 to 4 months. We did get that right. Whether the US economy can stabilize at current levels, the infrastructure bill has been passed finally, but it is a bill that's much reduced on the original ideas, and there's still that social network bill to come, which is a little bit larger. And again, this is putting money into the US economy, but it's not money into the US economy that is in the short term going to make a massive change. So the United States also is going to see their Federal Reserve raising interest rates before the RBA is, hence the weakness in the Australian dollar. And that weakness in the Australian dollar we've got pretty well over the last week or so, forecasting as I did that the risk for the Australian dollar over the medium to long term is in fact 65 cents. And we're already going rather quickly in that direction. The other market, of course, that I keep mentioning is gold, and we've been saying steady accumulation of gold will pay off, and that is really looking quite good. So keep buying gold. It does look like it's in an area here where it could break higher. I would keep buying the US dollar. I'd be very careful about the stock market, and I know it keeps going to a new struggling record high, but it's still a new high. But I do think that Tesla is going to have a drop on the day, obviously, because he has a $14 billion tax bill coming, or apparently some are saying. So he's asked his Twitter followers if he should sell 10% of his Tesla stock. Maybe you can put the two things together, I'm not sure. But certainly Elon Musk in recent weeks has himself felt that the Tesla stock price was getting out of hand, and it didn't make sense. It didn't matter that Hertz, for instance, were going to buy 100,000 cars because he can't keep up with the supply for the current order base. So it isn't going to actually boost the business at all over the near to medium term. So he himself felt his stock price was getting out of hand. I certainly do, and I'm a big fan of Elon Musk, and I think Tesla has a bright future, but its justification, its price levels here cannot be justified. Elon Musk's own holdings in Tesla, and they made about 900,000 cars last year, which is very small compared to other car manufacturers. And his stock holding alone is worth more than Toyota. And in fact, Tesla's stock value now is worth more than the next 9 largest car manufacturers in the world combined. Now, if that isn't a bubble market, I don't know what is. Obviously, the future for Tesla is bright, but that is overvaluation. So I think it's highly likely Elon Musk will be selling his stock, and that is going to put pressure on the Tesla price, which in turn is going to pressure the NASDAQ, which in turn will flow through to the S&P 500 and eventually the Dow Jones. I just think it's a little bit tricky here at the start of the week to be blindly buying stocks. I would caution against that. Much prefer to be selling the Australian dollar and buying gold. In terms of the Australian stock market, the great underperformer remains the great underperformer, going nowhere while the US stocks go to record high after record high. The Australian market is in trouble. It is no longer the flavour of the month. The Australian brand is greatly tarnished on the international stage, and we've been alienating our biggest trading partner, and the global investment community is not blind to that fact, and they can see some real long-term damage being done there. Australia just slipped from the second largest provider of food imports to China to the 4th, so that's we're falling down the ladder pretty quickly as China chooses to shop elsewhere, as well as its right to do so. So that's why I'm cautious on the Australian stock market, bearish the Australian dollar. The Fed will be hiking first, so the interest rate differentials will work against the Australian dollar, as well as we've probably seen the best we're going to see on the trade front in terms of mineral exports, which were sharply down in that trade data last week. Clifford Bennett, Chief Economist, ACY Securities. Hope you have a very good afternoon, evening, and I look forward to speaking to you on our next episode. Don't forget to watch AusBiz tomorrow morning, where I'll be doing a little bit of a show there as well with the great team at AusBiz. Thank you very much.